for India Inc.'s top 5 tax asks. Watch the pre-budget special of The Fine Print at 9 p.m. tonight, only on Bloomberg Quint.
The record run in global markets and emerging markets like India continues. Indian equity markets and the Nifty index has taken out even the 11,000 level in trade this week. Of course, somewhere at the backdrop, fears of overvaluation, perhaps even asset bubbles continue to lurk. One thing that is supportive of the global markets moving up has been the global economy. The IMF this week has raised its forecast for global economic growth to its best levels since about 2011. What do we make of the global economy, global markets, and the risks that may be on the backdrop that need to be taken note of? Well, we've got with us Abby Joseph Cohen, veteran American economist and market strategist, joining us here on Bloomberg Quint today. Abby, it's an absolute pleasure to have you with us. Thank you so much for taking the time to speak to us here in India. My first question, Abby, to you is, on the IMF's global growth forecast, they've raised it a touch. Best growth that we are likely to see in the global economy since about 2011. Has this growth run taken you by surprise? And what do you think is sort of driving growth globally right now?
The growth picture for 2018 is very much a continuation and improvement from 2017. In addition to the average number going up for Goldman Sachs, we think this year GDP growth will be 3.8% globally. There is not an economy out there, other than some very small ones, that is in recession. So what we are seeing is something that is very broad-based, and it is happening in most economies with very low inflation. So it suggests something about the sustainability of this economic expansion.
That low inflation story, Abby, there are various theories out there. What is your own understanding of what is this low inflation being driven by? And now that we are starting to finally see oil move up, could that low inflation run break?
When we analyze inflation, it's always important to look at the structural aspects and then the cyclical aspects. From a structural standpoint, we think that there are some things that are pushing down inflation. Some people refer to it as the Amazon effect. I think it's more effectively and appropriately referred to as the competitive effect, in which in an environment in which there's good global trade and so many companies now have access to computerized distribution systems, we keep inflation structurally somewhat lower than it otherwise might have been. However, in the developed economies, including the United States, there's also been a very important cyclical component. Until the last year or so, there's been lots of extra slack in the U.S. economy. We're now in a situation where there isn't that much slack, and most importantly, in the labor markets, the unemployment rate in the United States has moved down. It moved down dramatically during the Obama administration. It's moved down more over the past year, and we're beginning to see wages increase. In the United States, historically, about 2/3 of all business cost is related to labor cost. Those labor costs are moving up. We actually think that's good news, because if workers are paid more, they're able to consume more, and that gives the economic expansion even more sustainability.
That's the structural aspect that you talk about, Abby. The cyclical aspect in 2018 could come via higher oil prices, although there too it has been argued that because of the shale component, because of the fact that large-scale U.S. production could come on stream if prices start to rise, that beyond a level perhaps oil prices would not rise. So you may see oil settling at 70 but may not move up to 100, which we've seen in the past.
In the United States, while energy costs are important, again, it's the labor costs that matter the most. And we do believe that those are starting to move up, especially for some of our lower wage workers. And again, that's good news. With regard to energy, you make some very interesting points. Not only is energy price tied to demand, which is rising, it's also tied to supply. And we think the supply picture is such that energy prices are not likely to move notably higher from current levels. Of course, anything is possible on a trading basis, but we believe that we're going to see WTI, that is West Texas prices, and Brent prices for crude basically in this $50 to $60 a barrel range. you are right that shale coming from the United States is one of those supply factors that will help keep energy prices under reasonably good control.
So keeping these dynamics in mind, growth, inflation, perhaps, wage rates and also energy prices. Abby, what's your own forecast of how quickly the Fed normalizes interest rates and also how you think over the course of the year, the winding down of the balance sheet process is going to move along?
I'm glad that you asked about both aspects of Federal Reserve monetary policy, because it's not just interest rates as we've seen in previous economic cycles, it's also what they decide to do with the balance sheet. That balance sheet was dramatically expanded in response to the global financial crisis, and it has already begun to get smaller. The Federal Reserve, taking advantage of the fact that the U.S. economy has come out of recession much sooner than the other developed economies, has been moving towards a somewhat tighter policy. I didn't say tight policy, but not as loose as it was. And we believe that this will continue both on the balance sheet side, but also on the interest rate side. Our expectation is that the Fed will likely move short rates somewhat higher during the course of this year. It will be data dependent. If the economy is doing well, if the labor markets are doing well, and if wages are beginning to rise in a more notable fashion, we think that short rates will be raised by the Federal Reserve not once, not twice, maybe 3 times or 4 times during the course of the next 12 to 18 months.
And the balance sheet wind down process, Abby, I mean, so far markets have handled it pretty well. Do you think it'll stay that way? It seems, I mean, if they manage to pull it off, if the balance sheet unwinds without the markets getting disrupted, then certainly a hat tip to the U.S. Federal Reserve.
Absolutely so. You know, clearly the Fed has done a very good job with a big assist from the rest of the world. Although the inflows into the U.S. Treasury market from outside the United States are not as huge as they were previously, they're still very significant. So there is demand for this paper. And at the same time, there's been another challenge, and that has been a great deal of issuance in terms of corporate bonds. You know, corporations in the United States are taking advantage of these extremely low rates, plus their belief that those rates will start moving higher. And so we are seeing a very significant increase in supply, but the global market, I believe, is doing a good job of absorbing it.
I mean, what do you take away from the flattening of the U.S. yield curve? A lot of people focused on that. Again, debate on whether it signals, anything fundamental, or it's been distorted again by the kind of supply-demand dynamics in the bond markets.
Sure. In years gone by, before there was a significant amount of international flows, a yield curve that went flat or negative was often a very bad sign. It was an indication that investors believed that the economy was going to weaken, perhaps move into recession. That is not the case right now. We believe the flat yield curve is an indication that there is good demand for that intermediate and long-term paper, and it is not reflective of anything of a problem. I would also point out that there has been not just a shifting up of the yield curve in which interest rates at the short end and the long end are all moving up, but there has been some steepening of the curve. It's not steep, but it's not as shallow as it was previously.
And the dollar, Abby, the softness in the dollar, the weakness in the dollar, has that been surprising to you?
The weakness in the dollar began right after the 2016 election. Some of this is related to concerns about the longer-term direction of the U.S. That's one explanation. The other explanation, which also must be taken into consideration, is that the dollar, using our quantitative models, was somewhat overpriced. by the end of 2016. There had been such enthusiasm to own the dollar, in large part because there were concerns about other nations, that the dollar was priced and valued in a high level relative to some other currencies. What we've seen over the course of the last 12 to 18 months is that there's increasing confidence in this global economic recovery. The countries that were struggling economically are doing better. And this is something that basically says, you know what, the dollar is an okay currency, but it's no longer necessary to run away from some of these other currencies. Let's always keep in mind that a currency is a price that relates to two different items. It is a respective price. So the dollar relative to other currencies has gone down, but we can also think that those currencies are going up because the underlying fundamentals in those nations have improved.
Sure. Abby, just want to switch focus to the equity markets. How comfortable are you with the way the equity markets have continued to run? The US, India, any market you name, and they're at multi-year, in many cases, record highs.
Yeah, we obviously spend a lot of time looking at that, and the fact that they are at record highs is one aspect. The aspect that we tend to focus on is they're at record highs, but what about the underlying fundamentals? If a stock market is selling at a very high price, but the underlying economy is in an unprecedentedly good position, and the corporate profits in that nation are also very strong, we become much less concerned about it. And so when we look at valuations, we basically say most equity markets are not stretched to the point of danger. They're certainly not as cheap as they were. When equity markets are cheap, that attractive valuation gives you a margin for error. If something does go wrong, either for a company or an economy on a short-term basis, cheap valuation gives you a cushion. What we have seen in recent years is the cushions have disappeared in many nations. That doesn't mean that those markets are overpriced, but it does mean that if the consensus forecasts for continued growth or continued earnings expansion are overly optimistic, there could be some danger. It also means that if there is a surprise of a geopolitical nature, there may not be, again, that cushion to protect us.
And the low volatility, Abby, that has persisted. Again, there have been those who have raised concerns about the fact that volatility is too low and it can't stay that way.
I am one of those. I think that volatility has been exceedingly low, not just in the equity market, but also in the fixed income markets. I'm more concerned, quite frankly, about the complacency in bond markets than in the equity market. In the bond markets, we have interest rates around the world that we think are just too low relative to interest rates, relative to inflation, relative to growth in those countries. And so we do believe that interest rates will likely be moving higher. We certainly forecast that in the United States. And here's the point. Interest rates are currently very, very, very low. If they start to go up, they'll just be very, very low and likely won't have an impact of a negative nature on economic growth. However, if interest rates do start to move up, even by a small amount, they will be having a mathematical impact on the value of bonds and portfolios and holdings. And we are concerned that many investors, including individual investors, are not prepared for that. You know, they've enjoyed not just low volatility, they've enjoyed rises in bond prices, and as interest rates have gone down and have stayed down, as we've discussed already, we think those interest rates are moving up. And if that's the case, there will be some pain, we believe, in the fixed income markets. The volatility that you asked about has been very low for a number of reasons. One is that there's confidence that this environment in the equity market, for example, of earnings progressions and so on will continue. There's also been a technical aspect to it, and that is the movement of many into so-called passive investing rather than active investing. And we believe that the use of ETFs and benchmarked index funds and so on is also contributing to the low volatility. Mathematically, that works in a unidirectional market, that is, a market moving in only one direction, and in this case, up. We do believe that if the market shows that it can move down, or it stops going up on a regular basis, the volatility will increase. This, again, while we always talk about the equity market, this may be more pronounced in the fixed income markets.
Abby, these global risks are some of the major risks to emerging markets right now. What do you make of the emerging market segment in India in particular, if you have a thought on our domestic markets? Again, fund flows have been strong, and that sort of has supported pretty much everybody.
Well, I will basically say we start with the fundamentals. How are the economies doing? And something that pleases us is that the financial crisis that was so devastating for so many economies, large and small, a few years ago, in many cases has become ancient history. And we are seeing that there are good trade flows in East Asia and South Asia. Economic growth seems to be continuing. With regard to specific nations, obviously we look at what's happening to those economies. Is the domestic sector strengthening, not just the export sector? And with regard to India, my Goldman Sachs colleagues who are experts in India have a positive view. They believe that some of the reforms undertaken by the Modi government are starting to have a beneficial impact. And with regard to the equity market, their observation is that while the market is certainly not inexpensive, it is close to full value at these levels, they believe that this is a market which is attractive, and they are encouraging our global investors to be invested in India at this point.
All right. Abby, my last question in today's times, can't let you go without asking you about cryptocurrencies, or perhaps better called crypto assets. How do you look at them as a veteran of markets? Is there a proper way to value them, a way to understand their valuations? What's your thought?
Well, when I think about cryptocurrencies, as so many people are trying to puzzle through this, I call upon my background not just as an economist, but as somebody trained in computer science. And so from that standpoint, I look at the underlying math of the cryptocurrencies and say, there may be something there in terms of the ledger system, in terms of electronic contracts and so on. But when it comes to the cryptocurrencies themselves, I have to say I find myself more cynical. Currencies, by and large, are backed by the full faith and credit of a nation, a central bank. They are regulated because we understand the store of value and they're convertible. Cryptocurrencies have not yet proven themselves to be useful in this regard. But I want to keep an open mind, and what we think is that the cryptocurrencies, which thus far have found a home in illegal transactions and drug transactions and so on, may in fact be quite useful in countries where there is concern and lack of confidence in the national currency. Some smaller nations, some nations where there is enormous political unrest. We also know this. Surveys show that the millennial generation in almost every country has some skepticism about structures and organizations and institutions. They have more confidence in computer systems. And so we need to keep that in mind as well. But at present, I think that the enthusiasm regarding cryptocurrency is something that's being driven more by flows of funds rather than by the actual use of these currencies. And the most recent data say that much of the money going into these currencies is coming from some emerging markets, primarily in East Asia.
All right. Abby Joseph Cohen, it was an absolute pleasure speaking to you. Thank you so much for stopping by.
Thanks for the opportunity.